We will be talking about private equity fund advisors, hot topics. I thought before we begin, each of the panelists could introduce him or herself, and why don't we start at the end with Steve Swanson.
Sure. Good morning. My name is Steve Swanson. I'm an assistant general counsel at Invesco. I'm up in New York. I cover our private equity and other alternative products, including the Invesco Private Capital and WL Ross private equity and venture funds, and our senior secured bank funds. Also spent time with Clifford Chance, Citibank, and AllianceBernstein.
Hi, my name is Carla Vogel. I'm the Chief Compliance Officer for EIG Global Energy Partners. We are a private equity sponsor in the energy space. We are principally located in DC, although we've got offices globally, and we are effectively privately held, and with about 120 employees.
Good morning, I'm Jen Duggins. I am co-head of the Private Funds Unit of the Securities and Exchange Commission within OC. Before I begin, just want to give my disclaimer, which is that the views and opinions that I express today are solely my views and opinions and do not necessarily reflect views and opinions of the staff, commissioners, or anyone else at the commission. Thank you.
My name is Jason Brown. I'm a partner at Ropes & Gray. I've been at Ropes & Gray for almost 20 years. My practice focuses on the Advisors Act and its application to investment advisors, with a particular focus on private equity managers. Relevant to this conversation, have represented clients, private equity clients on somewhere around 50 to 60 SEC exams, and our firm has helped at this point, actually, 15 private equity managers on enforcement investigations. So with that, let us talk about the private funds unit of the SEC. To the extent your firm is visited, it's likely to be as a part of that unit. And Jen, I would ask you to tell us a little bit about the private funds unit.
Sure. So maybe not, actually, Jason, because there are, in addition to the private funds unit, obviously there are other exam staff across our regions who do examine private fund, private equity hedge fund registrants, as well as the private funds unit. So it could be any staff person in exam coming your way. The private funds unit, as you may know, is a small unit within OC. We are out of headquarters location, so that means we report in nationally. However, our primary mandate is to conduct exams of private fund registrants solely, and we do that with the assistance at times of regional staff across the commission in OC.
Would it be possible to comment on some of the things that you look at with respect to selecting exam candidates?
Yeah, sure. So across the commission, we have a number of resources that we utilize to help us with our mandate. Those resources fall under staff and other divisions and/or units, as well as the various data repositories that are available to staff within the commission. So from a resource perspective across other divisions and units, the private funds unit relies heavily upon assistance from our partners in the quantitative analytics unit, or our quants as we affectionately call them. They are very helpful as we review trade blotters and look at trading data. We additionally use resources within our Division of Economics and Risk Analysis, or DERA. Those are our economists who also do a lot of data modeling, as well as understanding what's going on from a macro and micro perspective across our economy. We also rely on our colleagues in investment management who help us understand rules as they've been promulgated, and also work with us as we, as part of our mission and mandate, inform on compliance and help foster what potential regulation may need to be based on what we're finding in the field. We also partner extensively with the Office of our Chief Counsel, which is effectively like our internal legal counsel, to help us in our deficiency letter writing, making sure that we are adhering to the rules with respect to the deficiencies that we're writing, et cetera. We also may work with folks as a part of IM in our RIO division, our risk exam folks who help analyze a Form PF as it may be applicable and help us with any questions on the form that we may have there. So it really is a group effort, if you would, in our work in examining private fund registrants. With respect to the regional assistance that we have, because our registrant base comes from the various regions, we partner as well with regional staff, and they may join us on exam and provide their localized expertise for registrants in their space, and/or because the private funds unit is a national unit, we also have a responsibility to provide customer service to the staff of the commission from the perspective should they need any assistance or guidance on their own exams of private funds or as they navigate any particular complex strategies, et cetera, where they may need some expertise from those of us who specialize in the work of examining private fund registrants. To the point about data, so the Commission has a vast repository of data analytics that are available. A lot of that data, as I'm sure you know, comes from forms that our registrant base files with us, whether that be the Form ADV, the Form PF, 13F, and other various filings where data is culled and concatenated, as well as also reviewed to determine whether or not there may be any inconsistencies, for example, across Form PF or Form ADV, et cetera. We also have a large data group in Washington. We have our ORAS group, which effectively provides staff with information about registrants, information that's coming in. And that's where, for the most part, the pool of registrants for selection for examination are pulled from. The private funds unit may take that a little bit further, and we develop what we call theses, or idea generation, if you would, looking for areas of what we call opacity, areas that may be dark to an investor base or an LP base, if you would, trying to find pockets where there's not transparency or there may be potential harm to those who are ultimate investors within a particular fund. So if you've read from our priorities for 2018, we are largely focused and remain focused on the retail investor space, and that does, in my view, impact private funds, certainly from the perspective of those investors who ultimately may be investors of or in a particular pension plan that may be an LP of the particular private fund. So, we want to make sure, so for example, my mom is 86, when she gets her statements, I want to make sure that it makes sense from where I know she's investing from. So that's our ultimate point of concern from our priorities perspective. But that aside, you'll note that in the priorities that were published, there's a footnote that says that there may be other things that go on from a priority perspective that is not necessarily written within that document. And so the private funds unit in that regard, we effectively come up with ideas on where we think there may be pockets of potential fraud or things that we're seeing or hearing. We look through the news space as you do. So if you see something come through on a CNN alert or through Google or the cover of the Wall Street Journal, we're certainly looking at that information as just as you are. We're working with our economists, as I mentioned, and our data gatherers, and looking for publicly filed information and/or information that comes through as required reporting to help us analyze where we may need to conduct examinations. And so what we'll do then is we will, on a risk-based approach, I'm sure you've heard through the conversations on exams that OC operates on a risk-based approach, and that is true for the private funds unit. So once we have the data that we're looking at, it often returns, for example, hundreds of registrants. We will then cull through that on a further risk dive, and that may be information that comes through on a TCR, so a tip, complaint, or referral. It may be called down further because a firm was examined in the past and there is a potential for recidivist activity, so we may look at that. We may look at whether firms have never been examined. We may look at significant changes to an ADV or a Form PF where we may think those changes may ratchet up a firm on a risk profile. And then we'll call that list down. So there's no, magic number, but, for sake of conversation, let's say we select 20 registrants for examination. We'll then go out and do the same exam at different registrants over and over again to see if what we're thinking the result may be holds true. And then we will, at the end of that examination cycle, come up with what our findings are and, roll those up the chain. And perhaps sometimes those findings may net a regional office doing examinations in the same space. So I think the point to take away is that we are part of OC. We are a niche unit, but very small, but we work very closely with other members of OC, and then we work very closely with other members of SEC staff across the commission as we come up with our ideas, areas of focus, and then follow through in the space.
Great, thank you.
Sure.
So, let's spend a moment on recent developments. Trump was elected, the House and the Senate were under Republican control. I got a lot of phone calls of, am I gonna still have to worry about this now? For better or for worse, the answer is yes. While Trump promised a complete dismantling of Dodd-Frank, it hasn't happened yet. Based on, while there have been some pushes to get a private equity exemption from registration, based on all of our intel from DC, that is incredibly highly unlikely to happen. What we're hearing is more possible is something like, something more measured where, particular aspects of the Advisors Act as applied to private equity, you might get some relief on, although again, there's been a lot of pushing at this point and still not a lot of progress. The other thing I think that we're seeing is that a lot of, initiatives that were proposed under the prior administration have sort of languished a little bit and haven't been moving forward. I know you've discussed a lot of those already, the business continuity plan for rule, for example. But other initiatives like anti-money laundering, the incentive compensation rules. Again, those are things that we thought were sort of going to happen in the near future, and to date haven't. I was actually going to mention the DOL fiduciary rule, but as I assume most of you know by now, courts have invalidated that yesterday. A court invalidated that yesterday. So we'll obviously see where all of that ends up. The other thing I wanted to mention was, obviously we have new commissioners. We have we finally have 5 commissioners, a new chair, Jay Clayton, and I think people are seeing, some changes with respect to that. Jay Clayton is not a prosecutor the way that Mary Jo White was a prosecutor. As I think has already been mentioned, there is more of a focus, announced focus on retail, although I know, Steve, we were talking beforehand that doesn't necessarily mean there's some sort of an exemption on private equity at this point.
Well, yeah, Jay, it was interesting, and Jen, you touched upon that in your just a few minutes ago. I listened to the representatives from OC and enforcement talk yesterday, and it's an interesting topic for me when it comes to private equity funds in particular, because I'm trying to look for signs where to explore what the practical impact of the focus, this justifiable focus on retailization and retail investors, is going to come into the private equity space. I take that it's important to recognize that behind pensions clients and other clients there are large collectives of individuals, But it also occurs to me that it could be true of any institutional investor. Institutions and corporations are collections of individuals always. Sovereign wealth funds may be collections of entire nations. And so from a sponsor's point, we're always kind of, you're always aware of the fact that you could have an impact behind the client that's in front of you. But your focus is on the client that is in front of you and their systems and their processes. So when we're dealing with pensions and endowments and other institutional investors as a sponsor, it's a very rigorous process. They're some of our toughest LPs. They negotiate more than adequately on their side letters, on their disclosures, on the terms of our funds. The RFP process and the onboarding process for a new client is a very, very rigorous one. They do a lot of due diligence on us as a manager and as a fund. And so I'm trying to think, where is it that we have to start looking through that part of the process and our fiduciary arrangement and our other arrangements with the LP client, depending on who's standing behind that LP client? Because, again, it may be one thing for a pension, but any practical result that comes from that, do I then have to apply it to the other institutional investors, to endowments? Jason or Jen, is there, it's early days, but are we starting to see how this focus, this priority on retailization is going to come into the private equity space, and what I as a sponsor should be doing in response to it?
Yeah, I mean, at the end of the day, I guess I'd say two things. One is, from sort of an exam priority perspective, private equity exams are still happening. The intensity of the exams are still going on. It's still more or less the same. I think the frequency of exams is pretty similar, at least as I have seen it from my perspective. I think some of that is a recognition that there is a retail basis to, the investors in private equity, and that ultimately, while there's a lot of negotiation, right? There's a lot of diligence, there's a lot of negotiation. The concern, as you may have seen over the past few years, is that without adequate disclosure, you can do all the diligence you want, but there's still some things you can't get behind. And you might say, well, the institutional investors can protect themselves. And I think the view that at least we've seen on exams is, only if they have all the information of what's going on, because ultimately there is that end sort of retail investor.
Our perspective is, our institutional clients are not shy about picking up the phone and asking, what about this? We read about this. How is the firm responding to this? And we generally take the view that if one investor is going to ask for it, all of them are going to follow suit. And so it is, I don't know that there's ever been an occurrence where when we're responding to one ad hoc query, we're not prepared to make that disclosure, or we're incorporating that disclosure throughout, or because you can put a label on institutional versus retail, but at the end of the day, I think everybody, certainly from compliance with your legal hat on, is you're going to want to know that you have, equal, information out there that's not misleading. And that I think the key is, as a compliance professional, is communicating that and making sure that everyone in your organization's on board with that and understands, the importance of that, and making sure that those queries are sort of directed so that you can almost institutionalize, take a more institutionalized approach in the response, and that incorporate it in your DDQ, incorporate some of those ad hoc requests that are obviously not very specific to a client's fund. But if it's about fees and expenses, and if a number of your investors really want a further breakdown, then give everybody the breakdown.
One of our 4 pillars in OC is identifying and monitoring risk, and that's not new, right? So from an examination perspective, and again, I'm speaking for myself. In my view, we've always asked about who the underlying investor or LP is in a fund, depending upon whether a hedge fund or private equity. We may often, ask to see the list of who's who. We're looking to see where there may be risk to that body. So that could be an endowment, to your point. It could be a pension plan, pension fund. It could be high net worths who maybe because they are high net worth. There's an assumption that they are sophisticated, and that may or may not be true. They may have somebody investing on, making investment decisions on their behalf who, they may not read any of the documentation. Any of those fact patterns could happen. And so that focus on, who is the ultimate beneficial party is always percolating in the back and front of my mind as we look at a firm and funds in its entirety. It's not, exams are not taken on a siloed approach. It's the full picture of where there might be risk, where there might be a lack of transparency, and we're thinking about where there may ultimately be the potential for harm. And so the retail focus is certainly necessary, when I look at an entire risk package. So I think if my numbers are right, there are about 37% or so private fund registrants with the commission. And so that's still a large number. So our focus, will remain in the space, looking where the commission is primarily focused at this juncture in the retail space, but then also continuing the work that we've always done. And so, Jason, to your point about new commissioners, now that everybody is seated, which is wonderful, a new administration. It'll be 3 years in July that I've been with the commission, so still relatively new, but at least here long enough to experience a change in administration. And my day-to-day is still, status quo as it was, which I think is a very good thing.
And that's encouraging for me to hear on the particular point, because the message I think that's coming out following the priorities letter, including yesterday morning and here at this panel, is this is a continuation of what was already begun.
That's correct.
We've been in an environment where we are focusing across all of the investor base on transparency and disclosure and enhancing that dialogue and giving people the tools that they need to make sound investment decisions. And so my practical takeaway from these discussions as a compliance and legal professional is this helps my dialogue and Carla, to your point, advance the cause internally, that this is just increasing in importance, the work that was begun already. So for those of us that may have principals that have been doing this for 10, 20 or more years, that are used to a different private equity culture, and frankly, we're in the era of a lot of successful asset raises right now, where maybe a little bit of that is coming back, where people are like, look, just put something together, tell them, just give them the terms. Just I've got 100 investors lined up behind the other investor who may be asking those detailed questions. We don't live in that private equity world anymore.
Yeah.
We don't.
And I think just to frame this, to give you a little more context, I know you don't want to hear about your colleagues on the hedge fund side, but it may be relevant to just give you context around the focus on retail. So like, you might be thinking, well, where are you going to focus in the private fund space on retail? So one thing, we might do as an initiative on the hedge fund side is take a look at those hedge funds that have RICs as part of their investment mandate. So, or where they're sub-advising RICs, so a registered investment company or a mutual fund. So there might be issues to a retail investor from that side. So it's important to look through and look at, the potential for how those invested in the retail space potentially, Joe Blow on the street, less sophisticated, less knowledgeable, may be impacted. So that's, that's a distinction to try and just give you, color for how we look at it holistically across the whole private fund diaspora, in effect.
Yeah, so, and again, completely consistent with what we're seeing. As I said, shortly after Trump was elected and Jay Clayton came in, I had clients who said, well, even if we still have to remain registered, we're not going to get examined anymore, right? And again, I think the clear answer is, no. Yeah, right. Jen speaking for herself, not the commission. No. No. The exams are continuing, the intensity is the same, and in fact, I would say, from my perspective, the examiners are very knowledgeable now in a way that they weren't 5 years ago, and sort of really know exactly what are the issues, where are the places to look. I will say this, though.
But
Yes.
that's a good thing. Now that they're more knowledgeable, more professional, it won't be a long exam of fishing expeditions. They'll know exactly what to look for and when.
Yeah, and that's a good point. And so just to dovetail on that, one of the things that we do in the space that I'm in is if you've experienced an exam from the private funds unit, we will ask for production. We give you 2 weeks to provide it to us, and then we do a deep dive through that production, and then we set up what we call a long call with you, a long opening call, prior to us showing up on site. And that's really a firm's opportunity to basically present their best selves. So I liken it to how if you were trying to bring a prospect in, you put your best foot forward, if you would, and talk about the wonderful things that happen at your firm, how you do business. We hear from the C-suite, traders, portfolio managers, people who monitor risks, et cetera. And you talk to us about your business. We ask that you put together what we call a day one deck to talk us through your business. And that really helps inform how what we call scope, what the exam will consist of, what the risk areas are. So that when we come on site, we have a focused plan, if you would. In a perfect world, obviously things change, as we get there and dig deeper and start talking to you. And maybe our plan is we're there for 5 days, or we shorten that and we're there for 2 or 3 days. We adjust based on where we see the risk. And then, we go back and we may have phone calls with you. But you always know where we're going. We won't tell you, we're not allowed to tell you, why you've been chosen for an exam. But you will be able to see based on the interview areas of focus, if you hear us asking the same thing over and over again, as well as who we ask to meet with and what the topic is and what the additional requests tend to look like. It becomes fairly transparent, what we're trying to get to the bottom of. And it doesn't necessarily mean that we think that, there's something wrong. It more than likely is, to your point, that we're trying to just really understand what we may be missing. Because remember, examiners are human beings, right? And I don't say that lightly, we're human beings and we're all very different. So one's level of understanding, comprehension, some people may need to hear the same thing over and over again 2 or 3 times to fully understand how your business operates. Or perhaps we think your disclosure is vague and we don't understand what you mean. So it's important for us to say, okay, well, what did you mean by that? Or let me ask it a different way, or ask for additional requests to support it, so that we come away with the best possible understanding of your business, so that we don't end up writing deficiencies that are based on facts and concepts that may or may not be true, or that we don't understand.
So the other thing that we have seen is on the enforcement side. And I would say this, I think we have seen the enforcement folks perhaps a little bit more cautious than in the past. To be clear, enforcement investigations are still starting. We had several private equity enforcement investigations start in the second half of last year. So they are still coming. But I might say that we see almost a change in tone. The ones that did start in the second half of the year were more along the lines of someone from enforcement calling and saying, hey, I'm thinking about this, maybe it was referred by OC. I'm thinking about it a little bit. Before we proceed, why don't you guys prepare a presentation? Here's what we're looking into. Here's, we want to understand your approach to it, and then we'll decide if we want to really dig in further. That's not really how it worked sort of before that time period. Usually once you got a phone call from the enforcement folks, there was a 90% chance you were going to be settling at some point. Why is that happening? I mean, I don't want to speculate on that. Could be because, to have an enforcement action go through, you need a majority of the commissioners to approve it. And obviously the composition of the commissioners have changed. But at least from our perspective, based on our sample size, I would say we are seeing the enforcement folks at least a little bit more cautious. Any other comments on recent developments from the panel?
So there's a question that I think is just timely in this, what we've been discussing, so I'll just ask it now. So the question is the risk assessment done annually or periodically? So I think that's a great question. I think it's a constantly evolving thing. And so, kind of like you view maybe your compliance program and, you have this concept of an annual review, but, when we talk to folks at funds, they often say, this is a live document, we're constantly reviewing it, we may change it and update it based on the changes in our business, but, we're always working through it. And I think that's fair with respect to, assessing risk. I think it's a moving pendulum, if you would. And so as information comes in, I think the risk profile may change up or down. And with respect to, my unit, we're constantly coming up with, initiatives and ideas. And so therefore we are assessing risk. And the other important thing to note is that, if I pick a particular point in time, so let's say we are in now, March, and let's say we pull an initiative, out of the can, we've refined it, it's been up the chain, it's been reviewed and approved for us to proceed. Let's say we get to July, and ADVs have been updated right at the end of March. Financial statements have gone out after the 120 days, and things change. So and here comes July, and perhaps that information is now stale. So we often will rerun our data, or there may be a tip, complaint, or referral that comes in that may move a registrant up from 10 to like 4, so to speak. So think about it as being very, very fluid. We don't, for example, put a meeting in Outlook that says let's hit the risk button today. It's a constantly evolving process, which I think is important, right? Because you want our information to be as fresh as possible. And if we, choose to come to your firm and examine that the issue that we perceive is actually still potentially an issue or something that you're doing in your firm and you haven't made a change to your business, which is why it's important to do those other than annual amendments if you have significant material changes.
So we have gotten, I believe, if I'm reading it correctly, 3 different questions for us to comment on the TPG case that came out in December. And I will say the following. Ropes and Gray represented TPG in that enforcement action, so as you can imagine, I can't say a damn thing about it. Which is really too bad, because there's a lot you could learn about it if you know sort of how it ended up, where it ended up, and how we all ended up there. I assume, Jen, you have nothing to say. I
Not a
figured
word.
that as well. Unfortunately, I think you got the wrong moderator for that particular question, because I can't touch that with a 10-foot pole in public. The other thing, question we got actually segues beautifully to our next topic, which is kind of walking through some of the SEC's priorities. So here's, I think any discussion of what the SEC's priorities have been for private equity has to start with a discussion of fiduciary duty. By the way, we know the print is small, but there's no need to sort of read through the exact text. But anyway, fiduciary duty, because virtually all of the big issues that have come out of private equity have arisen from Section 206, breach of fiduciary duty. So I wanted to focus for a second on what is the fiduciary duty, because it's necessary to really understand anything else. The way that I look at it is that it is a disclosure-based fiduciary duty. So it's not like the trustee of a trust, where you always have to act in the best interests, of the trust. That's actually not the standard under the Advisors Act. The standard under the Advisors Act, as I like to think about it, is you have to act in the best interest of your client unless you have clearly and timely disclosed in detail the way that you aren't going to. What's an example of that? We may have time to get into it, but you may have in your disclosure that certain deals are not going to be allocated to a particular fund. It would have been in the best interest of that fund to have gotten those deals, but you have disclosed clearly and in advance that those deals are not going to go to that fund. That is not a breach of your fiduciary duty under the Advisors Act, even though it's not in the best interest of that particular fund. Now, the concept, yes.
Can I challenge that?
Sure.
And I know it's awkward because TPG is a great example of this. I think what the industry's feeling, and that's what sharing this perspective, that worked for the last 20 years, maybe 20 years ago. For the last 5 years, I think my observation is the SEC doesn't like the practice, and you have disclosed it. They're still likely to say your disclosure's not good enough. And that's incredibly elastic. Second guessing a disclosure is, easy. So I challenge you to say, I'm not sure it's really smart to tell clients if you disclose it, you're all set on an issue that's a sensitive conflict of interest type issue.
Well, Jenna, first of all, I assume you don't want to comment on
No.
that. Okay. So I will do my best to comment on it, and I have many more clients other than TPG, so I'm happy to address that sort of more generally, which is this. The debate that we get in with the staff during exams, and particularly, in particular on enforcement, is, was it adequately disclosed? Would a reasonable investor have walked away understanding that that was going to be the practice? So the way I would think about it is this. The position that I've seen the SEC take is it's one thing to disclose that you're going to take monitoring fees. And an investor might understand exactly how that is going to work. It's a whole other thing, and again, this is what the staff has been, telling us in exams and enforcement. It's a whole other thing to take 10 years of monitoring fees upon the sale of a company when you're not going to be providing services any further, and that those are going to end up in the firm's pocket. And that a reasonable investor reading a provision that says we will charge monitoring fees is not going to understand that benefit. Now, of course, it gets even more nuanced than that, because you could say, well, gee, based on my offset, actually LPs benefited from this particular activity. And then the response is usually yes, but an undisclosed benefit to the advisor is also a breach of fiduciary duty. The concept being that if the investors had known that there was going to be this benefit to the advisor, maybe they would have negotiated other terms differently, right? In other words, sure, they negotiated an offset of X, but boy, if they knew you were going to be taking $100 million of accelerated monitoring fees, maybe they would have negotiated a larger share of those fees. So the question isn't, have you kind of disclosed it? Have you sort of, have you touched on the particular point? The interaction between, private equity firms, their counsel, and the SEC in a lot of this has been, yes, but what exactly was said, and would a reasonable investor have walked away understanding that for purposes of determining, are they going to invest in your fund, and whether they're going to try to negotiate with you when they invest in your fund.
And Jason, I would build on that from the advisor's standpoint. It's an excellent question, and it's a conversation we have internally all the time. Because from a principle standpoint, it assumes that it's a fixed environment. There was at one point in time, this disclosure was always okay to do this action. Now, I would say that's never been true, and that's always the constant lawyers, compliance professionals debate with their principles. It's a risk spectrum. But certainly disclosure that was drafted 5 or 10 years ago may not, it's a question whether it was adequate then, to Jason's point. There's really a question about whether it's adequate now, and the tension for the sponsors is, I'm living with that document. I can't go back and rewrite that document. But the environment has changed. And so the conversation from a compliance and legal standpoint that I think we tend to have a little bit more often, or that I advise having more often, is where are you on the risk spectrum today? I've had a discussion recently with a principal who said, this was some issue was always okay. Did something change in the last 5 years? And my answer was yes. Yes, it did. It changed. And so we have to think about what our practices are today, what are we doing it under what documents, and where are we falling on that risk spectrum. And so we're all updating, and we'll get into more detail, I think, as we go through this. We're all updating our internal processes. The disclosure for funds you launch today is very different from the disclosure that you would have launched 5 or 10 years ago, but you're still living under those documents. And I think, I'll let Jason comment on it probably more than Jen, but Jen, feel free to weigh in, is the tension between when the SEC in an exam is coming in and finding issues for something that was drafted a while back and what your practices are today, and how can we can't go back and unring a bell.
So while I knew that, because I'm clairvoyant, right, that was certainly going to be a question, and while I knew that I was going to punt it, I actually do have, just a few comments about what may get a focus on 206 from staff, if that's helpful. So the first one is, it's a broad area, undisclosed or misrepresented conflicts of interest, right? So that's sort of the obvious caption. And then underneath that, some areas of focus of late, if you would. So fees and expenses, right? That's never going to go away. We're always focused on fees and expenses. But some things that, we're looking at. So much improved practices and disclosures, but still we see some issues especially in stressed situations, right? So zombies and things like that. So that may be a focus.
Can you expand on that? I don't know.
So a stress situation, so a fund in stress, a fund, not living up to what it thought it was going to, if it's a zombie, end of life issues and things of that nature. Allocation of investment opportunities, particularly related to co-investment opportunities. So a few examples there, quid pro quo co-investments for investments in future funds. And then, this may be an issue if the co-investment is generated at the expense of, the client. And then the use of related party service providers, which is obviously prevalent in, real estate. So there may be potential conflicts of interest or misrepresented conflicts of interest. That would be a source of the staff looking closely at disclosures in that space, and where, you may see a 206 48 or 206-2, depending, type of comment or focus from the staff.
Yeah, and I think the key, to get back to your original question, is making sure that your disclosure is specific enough that it gets the job done. I mean, to put it another way, if you have disclosure that says we may charge monitoring fees and they might accelerate upon a sale or an IPO and et cetera, we could defend that all day. Or co-invest is another great example. Early on, when private equity firms were getting examined, a bunch were getting co-invest deficiencies. And then people started putting in disclosure, right? We may have co-invest opportunities. You may not get them. You may even ask us to confirm that we want them, and we're still, you're still not going to get them. And here are the factors that we're going to look at as we consider that. And actually what Jen mentioned is identical with my experience on it. As a result, the co-invest deficiencies for most of my clients is if there is the quid pro quo. The concept is, yeah, okay, you've done a good job of disclosing that you may not get co-invest, we may cherry pick our co-invest. Investors get that when they come in. On the other hand, if you have promised co-invest to someone, that's something people need to know.
I can't help myself. It's just not that simple. And I want to make this clear for Ms. Duggins.
Of course not. It's facts and circumstances in every case.
We hire the finest lawyers in the world to put together LPAs and our pitch books and all of that cloud, discuss the conflicts. And the reality is that when you're trying to foresee conflicts down the road, it's like a foggy battle. It's not crystal clear where the rub's going to be in 5 years, or that some odd factual scenario generated itself that you had a big accelerated monitoring fee that, geez, I didn't even expect this windfall. This wasn't how we expected it to work, but it happened. Like, well, this is how the LPA works. The other people on the other side of the LPAs too are not, Rob Kaplan said it great yesterday, it's not a fireman coming in with a baby on his shoulder signing off on these LPAs. They're represented by the most sophisticated consultants. Oftentimes, the institutional clients on the other side are multiple handles bigger than us. Chinese sovereign wealth funds. And, to have this framework of second-guessing disclosures 5 years after this stuff was put together, it's really difficult. It's really difficult. So I just want to, it's not that simple to say, oh, just disclose it. Because that makes it sound as though this is really clear and everybody knows it. and, there's some sort of, mischief going on if it wasn't done. It's just not the case.
Well, and there's the tension involved in, I think, our practices. I sympathize with that, and I think this is where compliance and legal professionals really have to be an active part of the conversation and make their mark, because because the answer to most of these priorities is some form of show your work. Have thought about this issue, show us you've said something to your investors and that you're living up to those processes, so that it's not all kind of off the cuff the way it might have been 10 or 15 years ago. But the more prescriptive you are, like we all now have expense provisions that are 4 pages long, but that lends itself to a conversation, just as you were saying. Well, you didn't include, item double X in this, so therefore you must have thought 5 years ago that you weren't going to have that expense. When it was an issue, it's something new, it's a blockchain expense. I don't know, I'm making this up that you couldn't have conceived of 5 years ago. And so how do you craft a set of documentation that can be living and breathing and communicates to investors without having to be subject to the 6 or 7 year look back? And that's what I was saying earlier, is that's where you'd like to have a relationship with regulators where you're not being caught for foot faults, depending on, as I think Jen has acknowledged, the facts and circumstances of the case. But I think that is what worries us all. That you can't, and you don't want to sit down and come up with the laundry, because you're going to forget something, and that's going to be the thing you're doing. The tension is also, I challenge every one of us to kind of be able to have that conversation with our principals, because we all know the way this comes up is 5 years down the road, somebody says, hey, accelerated monitoring fees. There's an idea. There's a cash cow. We have some, revenue enhancement, return enhancement, whatever you want. Let's go do it. Lawyer, compliance people, do the documents say I can or can't? And giving that kind of black and white answer is difficult, because again, I'll go back to what Jen said, facts and circumstances. What did we think when we drafted this? What have we communicated to investors over time? Not only what did we say in our disclosure, what have we said in our quarterly reports? What's the dialogue going on? These are living, breathing, organic things.
Right, and I think I did say, earlier that we're looking at the whole firm and all of your practices and, everything, the whole picture, big picture, middle picture, lower picture, and trying to assess whether there's an issue.
Yes.
Your argument with the commission, or your supposition that it's a disclosure-based fiduciary duty, has that worked? When there was a question whether,
If the disclosure is on point and, fulsome, yes, it has. In fact, you would, I'm not an enforcement lawyer, but we've got a lot of them and they're extremely good. You would be surprised what they could do with disclosure that isn't even quite on point once you've reached the enforcement stage. And so we will, once you've sort of reached that stage, that makes the enforcement folks go away. And does it, I feel a little uncomfortable commenting on the exam side with Jen here, but
historical basis,
yes, it does. And inevitably, what you find yourself arguing with the staff about is, was this disclosure adequate?
And is that to a reasonable private fund investor or to a reasonable?
Yes, no, it's a reasonable private fund investor. In fact, what the staff will often do is call your investors. Like if you're really digging in on something, they will call your investors up and say, what did you understand? How did you feel about this? Because really that's the best evidence that the staff can use as to whether people actually got that this was going to happen. I've even had some clients where, we were deep on an exam and they got their LPAC to approve the fact that they understood what was going on, and that was it. That was the end of it.
If I can sort of maybe just add a slightly different perspective to the concept of a fiduciary duty and just moving away from the contractual and nature and the disclosure, I think it is important that you look at your organization, and does everyone in your organization understand that as a registered investment advisor that you do have the fiduciary, or potentially legally or otherwise, the fiduciary duty. And what does that mean? And sort of incorporating that into your compliance training, whether it's for new employees being onboarded or annually, because it comes up in so many ways. And while the main issues we're discussing relate to enforcement actions, which ultimately really reside, perhaps the people that touch that may be a relatively small number of people in your organization, just the overall concept of fiduciary duty really comes up in everyone's day-to-day, in managing conflicts, personal trading, gift and entertainment. And so I think that one of the things that once the legal team and people negotiating particular letters and contracts is just taking a step back and just accept the fact that whether it's for one client or all your clients, that you have an element of your fiduciary duty incorporated in your organization, and that you're socializing that and having people understand what that means as it relates to their functional area and their participation in the organization.
Great. Well, I have to say, I do a lot of speaking engagements during the year, and that was by far the most spirited discussion of fiduciary duty that I've ever experienced. So mostly I wanted to thank the audience for that. That was actually pretty cool. However, while we had that discussion, which I think was a great one to have and actually quite unique, what that means is we've got about 9 minutes left to sort of run through priorities. Jen mentioned it. I think maybe in light of that, look, to be completely frank, the priorities haven't changed a whole lot since you might have been to a similar conference, in the past few months. The slides obviously speak for themselves. There are different angles to some of the issues. There might be, it's still fees and expenses. There might be some new and different fees and expenses that have caught the staff's attention on exams, but the main sort of categories are the same. I think what makes a ton of sense is, maybe if I turn it over to Steve and to Carla, you have this fiduciary duty concept. You know what the priorities are. How do you guys think about it from a compliance perspective? How do you organize your compliance program, your policies and procedures? Steve, you've mentioned this several times, and it's critical, getting your top folks at your firm on board with what's going on in light of what the particular priorities are.
Yeah, I can start with this. So I would say that maybe in the theme of what I just said about having all employees understand what fiduciary duty is, recognizing, almost looking sort of from the, looking at this from the ground up. And we took a closer look this past year, even on our travel and expense policy. Historically, that hasn't resided, that's not a compliance policy, that's more of a corporate policy. But that's actually pretty fundamental to, every employee that may be traveling, that is, putting in fees and expenses for reimbursement, and, to the extent that those are then captured and expensed to the funds, it's actually quite a critical policy, and really working through that. And the first reaction internally, because other functional areas sort of own the policy, and I'm sure a number of you can appreciate this, people are very proprietary about their workflow, and really taking another look at it, looking at it more as a compliance policy. It still resides in our corporate space, but we spent a lot of time, really refreshing it and going out with some employee training on it, and having people understand really where, more than just getting your reimbursement in, and should you be traveling, should you be taking the Acela versus just the Amtrak, Northeast Regional. These are in fact, important issues. And, actually it does help to use, our internal travel agent, because they're the ones that are actually looking for the best price, not necessarily worried about your own reward points. So these are the things that, in summary, other than, of course, the bigger pictures, similar to what we were discussing about, I think these are the things that we've gotten a little bit more focused on this past year.
See, and I can, as you were speaking, Carla, I can envision the eye rolls going on, within the organization about that. But, let me give it to you from my perspective. So inherently, right, there's nothing wrong with, getting on a first class flight, or, staying at a nice hotel and taking the Acela and whatever it is. But when we come in, right, we're looking at what you're spending fund dollars on, or if those are fund expenses. And we're seeing, okay, well, let's see. There are, 5 people who all flew first class, who all stayed at top-notch hotels, and then we see that and maybe you've disclosed that, whatever, that's your practice, but typically we don't see that actually written out like that. But we see that the compliance program is not up to snuff, or it's sort of lacking in respect to attention that's paid to it, and the response that we get is, well, we're short-staffed, or that consultant costs money, or whatever it is. And so in our minds, we're like, okay, well, you say you don't have money, a budget for this, but then you're spending dollars on first-class travel, right? So is that inherently wrong? No, but again, that big picture of, what's the inherent issue here with this firm? What's the moral compass? How are they thinking about the business and, the LPs, et cetera? So, you look at it from that perspective of putting controls in place and thinking about practices, and then we look at the whole picture and, seeing where there are issues. So I think that's an important point.
Yeah, I think for us it was also, more about consistency of disclosure, because I don't know that in compliance we fully recognized up until the past couple of years, where we were really sort of going through some of the data rooms, how this is a frequently requested item by our institutional investors. And so, listen, if we were to permission everyone in the organization to travel first class all of the time, I don't know that the SEC would have an issue about it, as long as we've disclosed that, and that when asked for, that we're just being consistent with the level of our policy. And if certain things need to get escalated, because let's say, whatever there's a lot of heavy travel in our organization, flights are canceled and changed, and, sometimes what would have been $1,000, round trip plane ticket can become $5,000, depending on, just trying to get connections and trying to make a meeting and this and that. But as long as, we found that from compliance, as long as the employees were sort of given a bit of a protocol in terms of when to escalate, some guidelines in terms of how they can facilitate their travel, and that we can then just go in and review that, and or even better, have rely on an audit firm to sort of review and test that.
Carla, I think that's a critical point if we're getting near the end for everybody. If you haven't entered the show your work and the document your policies and procedure phase of your sponsor, your advisor, you're late. Start getting on board with that, but do it in a way that allows your business to be able to operate as a business, that gives them the breathing room, ideal or less ideal, to operate. It's not just a compliance person's wish list. So it is a dialogue. It is a dialogue between senior management and how they need to run their business, and your understanding and your ability to communicate what you hear from Jen and the SEC in the world. And I think most importantly, the thing that gets my C-suite's attention when we talk about these types of issues is what you just said, Carla. Forget about Jen for a second. She's a wonderful regulator. All that. Your investors are going to ask for this, and they're going to ask for it in ways you haven't thought of. They're not only going to ask to see your policies and procedures, they're going to sit everybody down for interviews. They're going to sit everybody down for interviews, whether it's your legal compliance staff, your portfolio managers. You're not going to be in the room together, and they're going to start examining, is everybody singing from the same song sheet? Does everybody have an appreciation, not just of how we handle your money, but are they living and breathing those policies and procedures? So beware the principal that just wants to throw up, that either A, hasn't bought into the show your work phase of the market right now, or whose approach is, okay, fine, give me some policies and procedures, just whatever. You're going to get caught out, if not by Jen, by the people who are bringing you money, and they're going to have other options.
So in the 2 minutes or 1 minute we have left, there's one question that we got that I'll answer. It says, what are the SEC's frustrations during private fund examinations? I think first and foremost, it's one, not being prepared. We're coming, you should expect that we're coming at some point. We give you tools for preparation, not being prepared. Having a not so friendly, rapport across the table, being, sort of closed off to being responsive to questions. Again, how you act is definitely noticed and recorded in our minds. And remember, exam staff are human beings, so try to be open as possible and view it as we're trying to understand your business. It can only have a positive net benefit for you to have an open dialogue with the staff. It's very important. and meet the deadlines that we set, and speak up if you need more time. We're open to questions, particularly if you have questions about the request list when you get it. A huge point of frustration is you don't ask to clarify, what is this, what do you mean? And then you have to redo production, and that sort of delays the exam. We're very open to you asking, like, what do you want from us? What is this? Et cetera. So try to make it an open dialogue. Think about it as if you would talking to a prospective investor or LP, and try to always put your best foot forward. It can only help you in the exam process.
Great. Well, thank you to all the panelists.
Thank you.
And thank you for all your great questions.